When the Alternative Credit Council recently predicted that the global private debt market will be worth in excess of $1 trillion by the end of 2020, some might have called the claim a little audacious. Only 7 years ago, less than £1 in every £10 lent in the UK came from an alternative lender. Today, alternative lenders account for more than a quarter of the total UK lending market. It isn't a fad, it is the new status quo. A summer survey of over 550 European institutional investors said that private debt would be one of their favoured investment asset classes in the next 3 years. The conditions for alternative credit's growth in the UK property market specifically couldn't have been better. It has come at a time when property finance from mainstream or high street banks is severely restricted. The banks that provided loans before 2008 have only returned to narrow parts of the property finance market, and with less than convincing enthusiasm. Thousands of creditworthy small and medium-sized property investment and development companies struggling to source the finance they need to finance their assets and grow their businesses. Add to that the sheer volume of outstanding loans that are due to mature and will require refinancing. Take, for instance, the commercial real estate market. In Europe alone, there are an estimated €500 billion of loans due to refinance in the next 4 years. Without the traditional lenders there to offer new loans, alternative lenders have a big gap to fill. But it's the surge in interest from the widening global pool of investors that's putting this alternative investment option so firmly on the map. The appetite from institutions like pension funds and insurers has ramped up exponentially. One of the UK's largest pension funds, RPMI Railpe, announced this summer that it is boosting its direct lending allocation, on behalf of its 350,000 UK railway industry pension holders, to as much as £4 billion. The constant hunt for yield is, unsurprisingly, a predominant driver to private debt. In this lower for longer interest rate environment, the search for income is a perennial preoccupation for investors. Plus, with equities at high valuations, new equity issues underperforming, and bond yields hitting historic lows, private debt has become the light at the end of the tunnel for yield-hungry allocators. But what, beyond yield, is putting property debt investments so firmly on the radar of our pension funds and insurers? Simply put, property equity investments are not as attractive as they once were. We are observing a marked shift among investors from direct property equity investments to the private debt route. As this extended economic cycle continues, the capacity for growth in property investments is tailing off. Furthermore, with yields in most sectors at all-time lows and rental growth prospects for the residential and commerce. For more on this story, visit the news article link.